Ever wondered exactly when you can expect your state pension payments to hit your bank account? Stay tuned as we unravel the schedule and key factors influencing the timing. Before we dive into the details, don't forget to hit like, subscribe, and drop a comment below if you have any questions or experiences to share about the state pension. Today, we're going to explore when the state pension is paid and what that means for you. We'll look at how payment dates are determined and what influences these dates. This video aims to provide you with a clear understanding of your payment schedule. In this video, you'll learn not just about the general timing, but also how personal circumstances and public holidays can affect when you receive your pension. Each pensioner's payment date might differ slightly, and it's crucial to know why. Understanding your state pension payment schedule is essential for financial planning. It helps you manage your budget better and ensures you're prepared for the month ahead. So, let's get into the details and make sure you know when to check your bank account. The state pension in the UK is paid every 4 weeks into your bank account. This system operates on a cyclical basis, which means that it's not paid on a specific date each month, but rather every 4 weeks. This equates to 13 payments per year, rather than the usual 12 that would come from monthly payments. Payment days are determined by the last 2 digits of your national insurance number. This unique approach ensures that the system is spread out and that not everyone is receiving their pension at the same time. For example, if your national insurance number ends in digits from 0 to 19, you are likely to receive your payment on a Monday. In case your designated payment day falls on a public holiday, the payment is usually processed earlier. The Department for Work and Pensions ensures that you receive your pension before the holiday, so there's no need to worry about delays. For new pensioners, the first payment might take a few weeks to start after you reach the state pension age. It's important to apply for your state pension 4 months before reaching pension age to avoid any delays. Once set up, you'll receive a letter that tells you when to expect your first payment. The exact date of your first payment can also depend on when you were born. The state pension age has been undergoing changes, gradually increasing to balance the system as life expectancy increases. This change affects when individuals can start receiving their pension. It's also worth noting that the amount you receive can vary. The full new state pension amount is different from the basic state pension, with the former generally offering a higher weekly payment. However, the total amount you're eligible for will depend on your national insurance record. You may also receive additional payments like the pension credit or other supplementary amounts if you qualify. These too are scheduled around your regular state pension payment, making it easier to manage your finances. The state pension is uprated annually by whichever is higher out of the Consumer Price Index, average earnings growth, or 2.5 under the current triple lock guarantee. This means your pension amount should increase each year to keep up with the cost of living. Managing your state pension effectively requires understanding your payment schedule. This knowledge ensures that you can plan your expenses accordingly and avoid financial stress. Always keep an eye on your bank statements around your expected payment day to confirm the deposit. For those living abroad, the payment schedule might differ slightly. The UK government has arrangements with many countries to handle state pension payments overseas. However, the increase in the pension amount might not apply if you reside in certain countries. In summary, knowing when your state pension is paid helps you maintain financial stability and plan ahead. Keep your national insurance number handy and always update your bank details if they change to ensure uninterrupted payments. Your state pension is a vital part of your retirement income, and managing it well can lead to a more comfortable retirement. Remember, each pensioner's situation might be slightly different, so it's crucial to keep updated with information directly from the Department for Work and Pensions or consult financial advisors for personalized advice. Understanding when your state pension is paid comes with its own set of advantages and disadvantages. Let's explore some of these to help you manage your finances better. One major advantage of the state pension system is its predictability. Once you know your payment schedule, you can reliably plan your monthly budget around these dates. This predictability helps in managing regular bills and expenses without much hassle. However, a disadvantage is that payments are made every 4 weeks, not monthly. This can be confusing because it doesn't align perfectly with monthly expenses that are common for most people, like rent or mortgage payments, which are typically due at the start of the month. Another advantage is the early payment adjustment made for public holidays. If your payment date falls on a bank holiday, the pension is paid earlier, ensuring that you have access to your funds when needed without interruption. On the downside, the 4-week payment cycle means you receive 13 payments per year rather than the 12 monthly payments that many are accustomed to. This can make it challenging to align your budget since the payment doesn't come on the same date each month. An additional advantage is the system's use of the national insurance number to stagger payment dates. This spreading out of payments ensures that not everyone is accessing public or banking services at the same time, which can reduce wait times and system overloads. However, new pensioners might find the initial wait for the first payment a disadvantage. If planning isn't done well in advance, there might be a financial gap until the pension payments begin, which can be stressful for those without alternative income sources. For those living abroad, an advantage is that the UK government has agreements with many countries to allow for the payment of state pension overseas. This flexibility can be crucial for retirees who choose to move abroad. Yet, a disadvantage for overseas pensioners is that the annual increase in the pension might not apply depending on where you reside. This lack of increase can affect the long-term value of your pension if you live in a country not covered by the increase agreement. Before we move on to the rest of the video, if you are finding this helpful, please like, subscribe, and comment, as it really helps this video reach a wider audience. Here is a case study related to when the state pension is paid. John, a retiree in Manchester, faced issues initially with managing his finances due to the 4-week state pension payment cycle not aligning with his monthly rent and utility bills. To cope, he contacted his bank to arrange a meeting with a financial advisor. Together, they set up a budget that accounted for the 13 payments he would receive each year, smoothing out his cash flow throughout the month. John also decided to automate his bill payments and shifted some due dates with his service providers so that they would align better with his pension deposits. This proactive approach helped him avoid late fees and the stress of manually juggling funds each month. His case highlights the importance of planning and communication with financial institutions to manage the irregular payment schedule effectively. If you're anticipating or already receiving the state pension, consider reviewing your payment dates and comparing them with your monthly financial obligations. If there's a mismatch, like John experienced, it might be helpful to rearrange some of your bill payments. Many companies are willing to adjust payment dates if you explain your situation. Additionally, setting up a buffer savings account could be useful. This account can help you manage the weeks when the payment cycle might leave you short before the next pension deposit. Transferring a small amount of each pension payment into this buffer can provide peace of mind and financial stability. If you found this video useful, please don't forget to hit the like button and subscribe to our channel. Your support really helps us bring more content like this to you and is greatly appreciated.